Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about liabilities. We talked about what liabilities were in general, and then have focused the rest of our discussion on current liabilities, specifically breaking it down into determinable and contingent liabilities. Now, we've done several examples of determinable liabilities, and we've started talking conceptually about what contingent liabilities are, but we need to do some examples of this special kind of liability. And that's where we're headed in this segment, is doing some of these examples. And we're going to start with warranty expense. A warranty is the promise that we will fix something or replace something if it breaks within a certain period of time. And we've all seen these in our purchases of a tablet or a phone or a camera, etc. We get this little notice on the box that says that there's a 1-year limited warranty, etc. That's what we're talking about with what we call an expense warranty. That's what Candy Incorporated is offering, is a 1-year warranty that's part of the machine itself. So it's part of that purchase price. The machine sells for $150, the cost is $90, and part of that $150 price is this automatic warranty. We want to make the appropriate adjusting entry for warranties if the company estimates that 5% of the sales will need to be replaced by the warranty within this 1-year period. Assume that Candy has already honored 100 warranties on this year's sales. The idea here is that if I make a sale in this period and it breaks down next period and I have to fix it, then the cost of that fix is actually part of making this year's sales. So what I'm trying to do with warranties is match up the cost that I'm going to have to pay in the future with the revenue that I got this year as part of my sales. So perhaps the best way to think about this is with a timeline. Here I go again with my pictures. So this is 1/1 of year 1, the current year, and here's 12/31 of year 1, and here's 12/31 of year 2. And somewhere in all of this, we sell one of these machines. So this is a sale. So according to the terms of the warranty, I now have to honor this warranty from here when I make the sale until 1 year later. And these sales are happening all through the period. We've got all sorts of ranges from the very first day to the very first day of the next year, from 12/31 to the next 12/31. The sale was in year 1, but the warranty is going to extend through most of year 2. And this is what we're trying to estimate and deal with the warranty expense, is the fact that the money came in, the sales revenue was recognized in year 1, but the cost is probably going to hit me in year 2. So FASB, in looking at this, came up with a good way for us to keep track of these costs. What they said was, look, if you're in the year of the sale, right through here, then when somebody brings in a broken product from a sale earlier in the year, then you're just going to record that as a warranty expense. Since you're in that same year, you can just expense it, take out the replacement cost out of inventory or a little bit of cash to fix this unit, whatever it costs. But then at the end of this year, you're going to estimate what you think you're still going to have to replace in the following year. So this is going to be an estimate. And what they want us to do is record it as part of our warranty expense for year 1. So right here on 12/31 year 1, we're going to record this estimate and make it part of warranty expense. It's going to be one of our adjusting entries. So that's the idea with warranty expense. So let's take a look at this particular example with Candy Company. So Candy has sold 12,000 units over the course of year 1, and they think that 5% of those are going to break while under the warranty and have to be replaced. So they think they're going to have to replace 600 units. Of those, 100 have already been replaced. So that means I've got 500 left that they think they're going to have to fix or replace in the coming year. So if I want to record a liability for my estimated cost, I should take this 500 times the cost to replace or fix these units. Now, I don't know what an average cost to fix these units would be. It doesn't tell us. So let's make the assumption that when they honor this warranty, they simply replace the broken unit. They don't try to fix it, they just give them a new one. So since we're going to assume that they're going to replace these units, then the cost of each of these broken units is going to be $90, which means it's going to cost us a total of $45,000 to replace the rest of these 600 broken units. So let's take a look at some journal entries. So let's say somebody comes in on the 19th. They purchased the candy making machine on March 12th. And now, same year, it's broken. So my journal entry, since we're in that first period, or the same period as the sale, we're going to debit a warranty expense and credit inventory, because I'm going to give them a new unit. So the units are $90. Instead of making that cost of goods sold because I'm not selling them, I'm going to get part of warranty expense. This is replaced unit under warranty. And what we were told is that they've actually made 100 of these entries on various days throughout the year. So if I take 100 times 90, I can figure out what's in this warranty expense before the adjusting entries. So let's see, 100 times 90 would be 9,000. Now the next thing that happens is on 12/31, I make that estimate that I'm going to spend, we said, $45,000 replacing other units that people bought during year one. So I'm going to record a warranty expense for that $45,000, and since I'm obliged to honor this warranty legally, it becomes a liability to me to replace these units. And we came up with a clever name. We call it estimated warranty liability. Clever, huh? And this is an adjusting entry to record estimated liability to replace units during year two that were sold in year one. The result of this is that I get this warranty liability that I create, goes on my balance sheet for $45,000, and up here we now have the full cost in our warranty expense for year one of all the warranties we think we're going to have to honor from our year one sales. And that's what we were looking for, is to get that expense to be accurate so that the cost of making these sales is fully reflected when we show the sales revenue from those sales. Let's say that somebody comes in on January 15th of year two and they have a broken unit that they bought in September of year one. And we look at the paperwork, and sure enough, it's part of this warranty expense. So what would our journal entry look like? Well, we know we're going to give them a new unit, so we'll credit inventory. But this time we're not going to credit warranty expense because I've already recognized the expense. I recognize the expense over here. What I'm going to do instead is use up or honor some of that estimated warranty liability. And this is honored warranty from sale in year one. And we assume that we will make an entry like this 500 times by the end of year two. Now I get to the end of the year two and I realize that I've overspent my warranty liability, then I have a loss. I didn't estimate enough and I've had to record all this extra expense, so I'd record a loss on warranty. If I get to the end of year two and I haven't needed all 45,000, say I've only replaced 300 units, then I'd have a gain because I overestimated my warranty, and now I get to show this reduction in that earlier cost. The second kind of warranty is a little bit different than the expense warranty that we just covered. Basically, this is when you go into the store and you buy your tablet or your iPhone or whatever it is you're getting, and you pay the normal price, and on the box, you know, it says, hey, we've got this 1 year included warranty, and as you leave, the clerk says, hey, would you like to buy an extended warranty for that? And have it covered for an additional 2 years beyond the warranty that's included. And some of us say yes, and some of us say no. It depends on your personal preference and whether you like that extra security or not. But it's a separate item. It's not part of the sale of this tablet that we went to buy. It's a separate piece. And so FASB, in looking over that, just went, you know, those are two different things. We're going to treat them as entirely separate transactions. You're going to buy the unit and the 1-year warranty that goes with it, and then if you choose to, you're going to buy this separate warranty expense. And because they're separate, I don't need to record this warranty expense, this sales warranty expense, along with the sales revenue of making the original sale of this tablet or whatever the unit is. Instead, what FASB said is, you can record the expense of it as you record the revenue. What do you mean when we record the revenue? Well, you can't record revenue for the sales warranty either. Why? Well, think about the 5 requirements now to recognize revenue. Number 1, you have to have evidence of a contract. Well, we'd have a receipt, so we'd have that. Number 2, you have to be able to identify your obligations, and we know that. We're offering this 2 years of extra coverage. Number 3, we need to recognize the price. Well, we know the price. It's given to us right up here, $50. Number 4, we're going to allocate that price to the separate obligations. Well, in this case, 1 obligation, 2 years of coverage, 1 price, $50, so that $50 gets allocated to that 2 years. Then the final step is we recognize the revenue as we provide the service or deliver the good. Ooh, we were good on all 4 but that last one. I'm not going to deliver this good for quite a while now. Let's take a look at a timeline. So this is January 1st of year 1. And let's see, here we'll have 12/31 of year 1 and 12/31 of year 2 and 12/31 year 3, and finally over here 12/31 of year 4. So what we mean by this, what FASB means is that from the time they make the purchase for 1 year, they are covered under the original box warranty that's on the box or as part of the product that they bought. Then we're going to honor this additional warranty for 2 years after that. So basically what FASB is saying is you can't recognize the revenue until year 2 when you offer some of that insurance, to year 3 where you offer a little bit more of that insurance, and then into year 4 when you offer the balance of this extra insurance. So the bad news is I can't recognize the revenue. The good news is if I don't recognize the revenue, I don't have to recognize the expense either. So then the question came to FASB, well, how are we going to break this down? And FASB said, well, the expense you can just recognize as you go. So whatever expenses you come up with in year 2, year 3, year 4 for this sales warranty, you would just record as an expense as you honor it. So you'd give them the inventory, recognize the expense. As far as the revenue goes, come up with a logical way to allocate it. And that was the end of their instructions. So companies started thinking about this. And since FASB just said come up with a logical method, there's a lot of ways that we could do this. Number 1 is that you could just divvy it up over the 3 years to year 2, year 3, year 4, 1/3 of the revenue each time, call it good. Another option is to allocate it based on the percentage we think we're going to honor in any given year. And that last one is the most common. There's others too that you can think of and go through, but that last one's the most common. And we can see here we've already got an estimate over here of when we think those warranties will be honored. So let's see, 600 plus 900 plus 1500 gives me a total of 3,000 units, which we know from up here. And now I can get a percentage. So 600 divided by 3,000 is 20%. And 900 divided by 3,000 is 30%. And this last then would be 50% of the revenue. And what we're saying is you'll recognize 20% here in year 2, and 30% in year 3, and 50% in year 4, which really does make sense because chances are most people are going to break these units in the very last year covered. So that's how we record the revenue. And again, we're going to match up the revenue and the expense as they occur. So let's take a look at some journal entries just to hopefully solidify this pattern. So somebody comes into our shop January 15th of year 1 and they buy one of these candy machines. So let's see, we're going to recognize normal revenue for $150. That's the sales price on these units. We'd record unearned warranty revenue. We're going to assume that they bought one of our extended warranties. for $50. And we're not going to do it, but you would put in sales tax and everything in here too. We'll leave that off. And then they pay us cash for the $200. And since we've given them inventory, we'll record cost of goods sold and inventory. And the costs here are $90. Sold 1 unit with extended warranty. If we look at the information that we were given, we were told that we sold 12,000 units and half of them purchased this extended warranty. So 6,000 times. We're going to make this journal entry. So that means we're going to earn 6,000 times 50, a total of $300,000 selling this extended warranty. So how would we record this warranty? Well, all through year 1 we do nothing. As we get into year 2, it will depend. Some people in year 2 will bring in their unit that's broken, and it will be broken and still within the 1 year expense warranty. We'd record that amount and reduce our warranty liability and show the inventory going out. If they come in and they bring in their sales warranty to replace it, then we'd record a normal warranty expense that's part of this sales warranty and credit inventory. That's what we do. At the end of year 2, we say, okay, we figured that 20% of the sales revenue can now be recognized. So we put a bunch into unearned during year 1. Now we're going to take some of it out. So we will debit unearned warranty revenue and credit something clever like warranty revenue. So it's going from unearned to earned, and we said, let's see, 300,000, we said 20% in year 2, so that's 60,000, and that's what I'd recognize. And this is an adjusting entry to record warranty revenue earned. And we do the same thing for the other years. As we go through year 3 and into year 4, every time somebody brings in a broken unit, we'll debit warranty expense and credit inventory, because now we know these are under sale warranties if they're from year 1. And then at the end of each year, we'd record 30%, so $90,000 would be recorded in year 3 as warranty revenue, and we take that out of unearned warranty revenue. And as we get into year 4 and finish up year 4, now this warranty is all done, it's all expired. Anybody else who bought it in year 1, if they break it, they're now going to have to buy a new one because their warranty is gone. So we'd record the rest of the revenue, so we'd recognize the other $150,000 in warranties. Now, the last question with a warranty revenue like this is, was this a good deal or not? And the answer is, maybe. Let's find out. We show $300,000 total in profit. And we don't know the actual numbers. It's really going to depend how many people really brought it in, but we assumed that of those 6,000 people, 3,000 would bring their unit in to get it fixed. So let's see, 3,000 will actually have to have it fixed at $90 a pop. So $270,000. So if I take what I earn minus what I spend, assuming that I really did replace 3,000 units, then I made $30,000. And if I didn't have to replace a full 3,000, I've got more money. If I had to replace more than that, then maybe it wasn't a good deal. But we made $30,000 with relatively little effort. All it took was somebody saying, you want to buy an extra warranty? And we assumed a little risk, and that was it. So those are our warranties. That's how we keep track of expense warranties versus sales warranty. And the important concept here is that an expense warranty has to be recorded as a liability because it's part of generating the sale, and we want that warranty expense to match up with that sales revenue. A sales warranty is not part of that initial sale, so we match up the revenue and the expenses as we actually provide that service. We still need to look at a few more examples to feel comfortable with contingent liabilities, and we'll do that next time. I'll see you then.